Hi, welcome back to another edition of Flippers Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the weekend of Wednesday, April 29th, 2020. Conventional mutual fund investors actually padded the coffers of conventional mutual funds, and we will talk about exchange-traded funds a little bit later on, but these first initial numbers and summaries are basically going to be about the fund business, the fund industry as overall. But basically we saw about $77 billion come into the conventional fund business this week, and this, not surprisingly, is really been just a case of people putting money in safe haven assets, particularly money market funds. We'll go into details here in a second, but a little bit of a head scratcher, and maybe not so much, to be honest with you. Investors really heard some fairly good news during the week. We saw the first reopening of several states. Several governors decided to do soft reopenings in their economies. Letting people do curbside purchases, or gatherings of 10 people or less, or even going back to work in some cases. So we're seeing a little bit of a loosening of those requirements. In addition, we not only saw that, but we also saw the Fed come out and basically said they will do whatever it takes to keep and put the economy back on track. And then also we saw a decrease in the number of cases being reported of COVID-19. Now, I think that's where the stumbling block is. In our first week, I think people are really going to wait to see if we have another spike in that curve that we're starting to flatten, and I think that's what people are waiting on. But interesting enough, we had a phenomenal week of returns. The Russell 2000, which a lot of people were waiting for. They saw the S&P and the Dow actually do some good numbers over the last several weeks, and the Russell 2000, kind of a small cap, a more risky asset, people had not participated in. So I think investors were basically looking at the situation and saying, you know what, we haven't had a small cap or even mid caps participate in this rally. This time we did. They had a return of 13.25%. But as I said, if we take a look at the flows themselves, that really didn't pan out as what we might expect. What we saw was equity funds lost about $5.5 billion. Again, there's only ETFs, but we'll see here later on, or this is only mutual funds. We'll see that ETFs also had some negative flows this week. But back to the conventional fund business, equity funds lost about $5.5 billion. Taxable bond funds took in about $517 million. Muni bond funds saw some big outflows, $996 million this week. And then if we take a look at really where all the money went, and that is, again, and we've had it week after week, money market funds took in about $83 billion worth of net new money into that group. So that was where the story actually was. Now let's go ahead now and take a play-by-play look at what the macro groups did. If we take a look at the equity funds macro group, we see that for the fourth consecutive week, they had plus side performance, this time to the tune of 5.90%. Awesome return. And we saw that they lost about $5.5 billion for the third week in four that they've seen outflows. And this has been kind of the story as of late. We've been seeing positive returns, but again, investors not really willing to snap into place and snap up, I'm going to say, those lower buys. We don't know if there's another market bottom to be tested, and I think that's what people are waiting for. If we break this out even further, domestic equity funds saw about a $3.2 billion outflow. It's the third week in four that they've seen outflows, but they had a return of 6.36%. Phenomenal return. Fourth consecutive week that they've had plus side performance. But on the if we take a look at non-domestic equity funds, we actually saw some outflows as well. $2.3 billion, fourth consecutive week they've seen outflows. And then if we take a look at the return, not quite as strong as it was in the domestically, but still 4.92% for the week. Not bad. Fourth consecutive week they've seen plus side performance. If we take a look in a deeper dive, we see large cap funds actually took it on the chin on the domestic side, losing about $3.1 billion. And then we see that on the international side, or on the non-domestic side, international equity funds surrendered about $1.9 billion back to investors as a whole. Well, that brings us now to ETFs. And I told you ETFs, we actually experienced net outflows, which we haven't seen for about 4 weeks. Actually, this is the first week in 4 that we've seen net outflows from the group. This time to the tune of about $1.5 billion. And at the top of the group, as far as taking in money, was a Spider S&P dividend fund, that's SDY. It took in about $1.5 billion. And we see Invesco QQQ Trust 1 took in about $1.1 billion. But at the very bottom of the barrel, we see the Spider S&P 500, SPY, lose about $4.8 billion, and the iShares MSCI EFA ETF lose about $894 million. So really, that is something that we can say in common. More often than not, I'm talking about mutual fund behavior. We've seen outflows, and then we see ETF putting money back to work. This week we had a consensus among institutional investors and retail investors, and they both actually were pulling money out of the equity universe as a whole. Well, let's go ahead now and change our attention now to the ETF universe of the fund and ETF universe. Taxable bond funds actually saw money come in. This is the third consecutive week they've taken the net new money, but it's been the smallest amount. We saw them taking about $517 million. It's the fifth week in six, though, that we've seen plus side performance. Basically, this week it was the tune of 1.20%. And the big attractor of money was the corporate investment grade debt funds, took in about $1.9 billion. And then on the flip side, where people weren't willing to put more risk on, they saw government treasuries and mortgages taking about $222 million. But on the bottom side, where we saw the outflows was kind of in the riskier assets group, flexible portfolios handed back somewhere around $632 million. So that was a little bit of the story on that side. Let's go ahead now and turn our attention, though, to the fixed income ETF universe and see what happened in that group. Basically, the fixed income funds saw about $3.5 billion in net new money come to that group. Fifth consecutive week they've taken in net new money. And how that panned out is we saw the iShares 20-plus year Treasury ETF taking about $1.4 billion. We saw the iShares iBox Dollar High Yield Corporate Bond ETF taking about $772. But on the flip side, we saw the iShares U.S. Treasury Bond ETF lose about $1.1 billion, and as might be expected considering what's going on nowadays with lowering interest rates and the like, iShares Floating Rate Bond Fund took the biggest loss, losing about second biggest loss, losing about $829 billion this week. And so that was, a kind of an expected story when we take a look at it. People were willing on both the conventional funds and also on the ETF universe to put a little bit more risk on, be willing to go a little bit longer, let's say, or I shouldn't even say longer, but back into bonds. And I think it's because the Fed has pretty much indicated that it's willing to do anything it can, and we're seeing some of those spreads lower a little bit from treasuries to, let's say, corporate investment grade and the like. Well, let's go ahead now and turn our attention to the muni bond fund universe and see what happened in that group. Basically, muni bond funds lost about $996 million. It's the first week in three that we've seen outflows. Second consecutive week, though, that they've had negative performance, this time to the tune of 1.24%. And the pariah of the group was high-yield muni debt funds. We'd expect that, about $721 million in outflow. But short muni debt funds, people kind of saying, gosh, the spreads are tightening a little bit and the like, and short-term seems to be a little bit more realistic. They saw about $63 million of net inflows come into that group. Now, when we take a look at that, though, we also include muni debt as far as ETFs flows, and we saw that the municipal bond ETF group lost about $259 million this week. And so really that brings us to our next major group and the kind of last group that we usually talk about, and that is our money market universe. And the money market universe basically took in money. Again, we've seen, look at all these monster numbers, $72 billion, $46 billion, $122 billion, and this week, for the weekend of 4/29/2020, basically we saw about $83 billion net new money come into that group. It's the ninth consecutive week they've taken in money. And how that broke out is taxable money market funds, so about $85.4 billion come into their coffers. And how it broke out, we go a little bit further in detail on that. Institutional investors, and when I say that, institutional accounts, this can be our 401ks, our IRAs that are kind of in the omnibus accounts or in our 401ks and the like. They pretty much had $80.6 billion in net new money come to that group. And retail investors or retail money market funds, those are not usually qualified plans and the like, but they can be. They can be IRAs. They saw about $4.8 billion in net new money come to that group. And at the bottom, what we saw was tax-exempt money market funds. Basically, hand back about $2.4 billion this week as well. Well, that pretty much ends that for us. I mean, this is kind of at the end of my conversation, but there's a couple things going on that we're going to keep a very clear eye on. And one of the clear eyes that we're going to be paying attention to is obviously the Q1 earnings season. Nobody expects any guidance, and we are seeing some surprises to the upside. Now, you got to remember, these are lowered expectations that are out there, and so we are seeing a beat rate that, it seems to be beating analysts' expectations. They're much lower expectations, but I think people are going to be very, very keen to see what the funds do. What the equities do out there, and then also what kind of guidance, if any, that the corporations are going to give. Also, we're going to keep an eye on the COVID-19 cases. As we look at the governments and states that have opened up recently to see if there's any reoccurrence or spike in there. And we're also looking at yesterday and today we saw the Bank of Japan and the ECB and other central banks meet to talk about possibly providing more easing, more cuts, more money, injecting more money into the system as well. And we'll have to see how that pans out. Well, if I didn't do a deep enough dive for you, you can go to our site at www.lipperusfundflows.com. Or you can join us next week when one of our analysts will be talking about the flow trends of the week. Thanks for joining me. My name is Tom Roseen, wishing you the best in wealth planning and creation, and stay well out there.